Standard 3, duties to clients. There are 5 uh, subsections here. Let's start with Standard 3A, loyalty, prudence, and care. Members and candidates have a duty of loyalty to their clients and must act with reasonable care and exercise prudent judgment. Members and candidates must act for the benefit of the clients and place their clients' interest before their employers or their own interest. Very important. So clients come above the employer and yourself, right? So you have to place clients' interest above yours, and you have a duty of loyalty to your clients, and you have to exercise prudent judgment. That is, when you are giving a recommendation, you should have thought about it, done analysis, and then give the judgment based on your analysis. And also reasonable care. You can't just say go buy the stock. You need to see what is the IPS, what is the risk tolerance, and then decide and give the investment recommendation. So let's look at this in a little bit more detail. The primary duty is to prioritize the client interest. The professional conduct standard says conduct oneself with the appropriate level of expertise, attention, and careful judgment as expected from someone experienced and proficient in professional situation. People are coming to you because you are a qualified professional and you are supposed to be using your expertise, making sure you're paying attention to all the details like risk tolerance, liquidity needs, like in portfolio management, we saw that RRTT, and then you consider all of that, and then you give a recommendation, right? Not without any proper due diligence. Compliance, administer client pools strictly according to the governing documents like trust or investment management agreement. So if you're supposed to be managing a pool of money as large cap growth, but then you bought some small cap in that, so those are all not compliant, right? You have to be mindful of that. Proxy voting responsibility. So if you are a manager, you will have to vote on some of the board resolutions, appointees for the board members, etc. So vote responsibly. Vote in the interest of your end shareholder, not for your company, but what is beneficial to your client, right? So the biggest ones are Vanguard, State Street, and BlackRock. They are the biggest institutions, and oftentimes people are blaming them. They vote together, and so sometimes it is not in the best interest of the end client. So that's a big debate that is going on. Explanation. Standard 3A states that the members and candidates must prioritize client interests, manage assets as per the governing documents, make informed decisions based on the client's entire portfolio, not only the money that you are managing. They should be transparent about advisory limits, vote proxies responsibly, use client brokerage for client benefit. This is what we saw in Standard 1 as well. If you're getting soft dollars or hot dollars, make sure you use it for a particular benefit to the client, not for your company benefit or your benefit. Regular reporting and firm policies should focus on client-centric objectives, transparency, and best trade execution processes. Okay. This is loyalty, prudence, and care. Let's look at one example question here. Alexandra, a recent enrollee in the CFA program, works as a broker for a brokerage firm, primarily handling trade executions for a group of institutional clients. She strictly follows the instructions provided by her clients. Oh, this is a good one. And doesn't offer any investment advice. However, she is uncertain if the CFA code and standards require her to assume a fiduciary responsibility. What is fiduciary responsibility? Fiduciary means what? You are responsible for the welfare, the well-being of that asset or the person. So that means you have to take care, you have to see if it is detrimental to that investment, you will say no. Only positive. If you do an analysis and you say, okay, this is a good thing to do, only those things you can do. If it is bad for the client, you cannot do that. That is a fiduciary responsibility. Concerned about her obligation, she decides to rise to the CFA ethics help desk, ethics@cfainstitute.org for clarification. Wonderful. So she is not sure whether she has to just execute the order, whatever the client says, or she also has a fiduciary responsibility. Okay. If the client says invest in that penny stock $1 million, maybe it is not good for the client. She thinks that is not a good trade. should she place that order or not? You understand this one? Does Alexandra's role, which is limited to executing trades based on specific client instruction without providing investment advice, place her under any fiduciary duty according to the CFA code and stuff? See, if you are a person who executes trades and someone says you buy some out of the money calls, some 3,000 calls on ACC, right? That will expire next week. You know that it's most likely going to expire worthless. They will lose all the money in the trade. Should you place that order or should you not place that order? See, if you are just a broker, your job is to do what? To execute the trades. So the client, it's up. You're not having, are you having fiduciary responsibility or not is the question. So let's look at the choices anyway. A, yes, because all members and candidates in the CFA program are automatically subject to fiduciary duty. No, because her role is limited to executing trades, she doesn't provide investment advice or make decisions for client. Yes, but only when executing trade for high net worth individual clients, not for institutional clients. D, no, unless she voluntarily chooses to assume such a duty in her professional capacity. She does it voluntarily. That is choice D. A, B, C, or D. What do you think? Yeah, she's saying it is a fiduciary responsibility. So it's not like we not place. Can she like talk to the client and give investment advice? Like this is not a good trade. Can she say that? Yeah, see, she's only a trade executioner. So like her job is to execute trades. Her role is very limited to executing trades and she doesn't provide investment advice because you don't know what is this for. Maybe the client has placed a trade where they have sold calls and then they might be hedging here by placing a buy. You don't know the entire scenario. You are just one of the brokers they might be using. We don't know their strategy, right? We don't know what they are holding. Maybe they have a underlying, they have some exposure, they might want to hedge. There could be a lot of reasons. You are not in the role of an investment advisor, right? You are in the role of executing trades. You don't have a fiduciary responsibility there. Your role is to execute the trade flawlessly, right? Like that is you. It's all about just execution that you are doing. Understand this? Is focused on accurately executing trades. That is the role of Alexandra. She's there to execute the trade as accurately as possible and instructed by clients. She doesn't offer investment advice or make investment decisions on behalf of our clients. She doesn't assume a fiduciary duty as per the CFA code and standards. Okay, understand this? So this is some extra like color the CFA Institute has given. So to choose the correct answer, it is crucial to understand that a fiduciary duty in the context of CFA code and standards arises from the nature of the professional services provided, not just because you're a CFA candidate or member. You could be a CFA candidate or member. You could be even in marketing. Doesn't mean like you have to have a investment fiduciary role then. Understand this? Standard 3B, fair dealing. Members and candidates must deal fairly and objectively with all clients when providing investment analysis, making investment recommendations, taking investment action, or engaging in other professional activities. Okay, so this word fair is a very dangerous one. What is fair? Right, when you're having multiple clients, how can I deal fairly with all the clients, right? So you have to deal fairly and objectively. That's what they're saying, right? So let me ask you this one question. Okay, now you are writing a research report and someone is willing to pay you more money. Can you send them the research report first and then the other clients a little later? Everyone has to get the report same time. Okay, what if I told you that the advisor or whatever the firm you're running, let's say you're an investment banking sales side team, you are having gold, silver, bronze service tiers, right? The gold one is monthly subscription is 10,000, silver is 5,000, and bronze is 2,000. Can you send a little quicker to the gold one?
Unless until you have to treat everyone
See, there can be different service levels. Okay, there is no harm in that. See, service can be slightly different. So for the the one that is having a one-on-one relationship manager, that person might call and say that there is this research report that is being published. Okay, and the research report is saying this is this blah blah blah. This is why we think this company is a good buy. But all of them should get the research report same time. Okay. But one person you can call and inform, other person you might just email. Everyone might get an email same time. But the one in the gold tier, you might WhatsApp them personally. You might email them. Apart from the email, you might call them. You might text message them. You understand this? You can give a higher level of service, but everyone should get the same recommendation, same point in time. Because now, particularly with e-delivery, there is no reason to send it as different timelines. Before, previously, yeah, when they used to write letters 50 years back, then yeah, so maybe someone is paying a little bit higher, you might send them via speed post, someone regular post, all of this. So fair dealing, primary duty, treat all clients equally and impartially in all professional activities, including investment analysis, recommendation, and actions. Avoid discrimination in distributing recommendations or taking investment action. Equal treatment is required, but fairness is essential. Accounting for inevitable differences in communication timing. This is what I was talking about. There could be some differences in communication timing. You might just send a regular email, whereas for another person, you will call and say, because they are at a different service level. They are paying you for that kind of a service, customized, personalized service. But in terms of recommendation, everyone should get the equal opportunity to act on it. Ensure all clients have the chance to act on recommendations. Clients unaware of changes must be informed before orders are accepted. Very important. So let's say you are having a buy recommendation on Mahindra. Last night, your research analyst has changed it to a hold or sell. Okay, they have made it to a sell. Now, one client is calling you to buy Mahindra. What should you do? Should you place the order? Inform about the new updated research report that now our recommendation is a sell, it is no longer a buy. Okay, even after that, if the client is saying, I want to buy, should you accept it? Should you accept that trade order? Then the client is making a decision for after informed opinion. You have done your duty. We think it is a sell, but the client is still going ahead based on his or her opinion. That is fine. Service level transparency. You have to be transparent. If you have like various tiers of service level, those are fine. Those are permitted, provided they don't negatively impact clients. These levels should be disclosed to all clients and prospect, with premium services available to any playing client. So they cannot discriminate. They cannot say clients from US only can subscribe to this one premium, whereas clients from other countries can't. You can't discriminate. Anyone who's willing to pay, you should offer the service tiers to all your clients who are willing to pay. And you should disclose what does that mean? What is a higher service level mean? Let's look at this question. Green Tech. GTS recently announced to market analysts that they expect a modest revenue increase for the upcoming quarter. Okay. Emily, a senior analyst at Delta, believes GTS management is downplaying the figures to create a positive surprise during earnings season. Based on her in-depth analysis and discussion with industry experts, she suspects the revenue increase will be a lot more than what GTS is saying. So in her official research report, she echoes GTS modest projections, but privately advises her top-tier clients that she expects a much higher increase, suggesting GTS as a strong buy, strong investment. Is Emily's approach to communicating her revenue expectation for GTS to different client tiers in alignment with Standard 3 Code of Ethics and Standards, that is fair dealing? Yes, because she's providing a large clients with exclusive insight based on her expertise. No, because she's not treating all clients fairly by sharing different information with different client tiers. Yes, because her analysis is speculative and she's required to report only the official numbers. No, because she should not base her reports on unofficial whisper numbers or rumors. Can we look at the choices? Yeah, B is correct. Very good. Yeah, she is not, She has done some research. She has talked to industry experts, and she's actually believing that the numbers are conservative. The numbers given by the management of GTS are conservative. It will be higher. Then she has to say that information to everyone. Okay. If she's not believing in her analysis, then she should not tell anyone. Okay. It cannot be unfair. So B is correct. Now, because she's not treating all clients fairly by sharing different information with. So this is the classic case of not fair dealing, right? This is unfair dealing. CFA ethics standard 3C suitability. Standard 3C suitability. So this one is a pretty long standard. Okay. When members are in an advisory relationship with a client, they must make a reasonable inquiry into the clients or prospective clients' investment. See, what is the difference between advisory relationship and portfolio management relationship? You are in advisory, you are an investment advisor, or you're managing a mutual fund. If someone is giving you money for your, investing in your mutual fund, are you supposed to ask about the risk tolerance and see if they should invest in this mutual fund or not? We don't have. We are supposed to manage based on our mandate. What is our benchmark, right? If I am managing to small cap value, I have to manage to small cap value. We would have given that in the prospectus. Right? It is the responsibility of the investor to see if that is accurate, if that is something they want to invest or not. But if I am an investment advisor, then I need to check whether if I'm putting the client's money in a small cap value fund, if that is correct, if that is suitable for the client. If you are a mutual fund manager, if you are managing any kind of a pooled investment vehicle, and you have a benchmark, your responsibility is to manage as per the mandate. What is your mandate? Whereas if you're an investment advisor, you have to make reasonable efforts to put the client money in a suitable investment vehicle. Okay? That's the difference. So the first part is about investment advisory relationship. Make reasonable inquiry into a client's or prospective client's investment experience, risk and return objectives, and financial constraints. So the liquidity, taxes, all of that. To make any investment recommendation or taking investment action, and must reassess and update this information regularly. This is our standard IPS process, investment policy statement process. Also, determine that an investment is suitable to the client's financial situation and consistent with the client's return objectives. Okay, not only what you have talked, it has to be on paper. Okay, what is on IPS? Mandates and constraints before making an investment recommendation or taking investment action. Judge the suitability of investments in the context of the total portfolio of the client, not only this particular investment, but the total portfolio. Second point, if they are managing a portfolio, if you are a CFA charter holder managing a portfolio to a specific mandate, strategy, or style, they must make only investment recommendation or take investment actions that are consistent with the objectives and constraints of the portfolio. What is the stated mandate, stated benchmark of the portfolio? You need to manage based on that. Okay. So if you are managing a large cap, you shouldn't be buying a lot of small cap stocks, right? That is the stated objective. So primary responsibility we just saw, gathering client information. This is, you need to do your survey, interview of your client and create the IPS that considers the need, risk tolerance, and suitability of leverage, short selling, all of this. Adherence to investment mandates. When managing funds, select investments consistent with the fund's specific index or benchmark or the mandate. So this is the difference between giving advice to a client and managing your fund. If you're managing a fund, stick to your benchmark. Managing unsolicited trade requests. For trades with significant impact, consider updating the IPS or conducting the trade in a separate account, depending on the firm's policy and client's agreement. Okay, you have written an IPS, all of this, but the client is saying, you know what, I want to sell my equity. I feel the market is going to tank. It is very overvalued. I want to exit 40% of my equity and move to cash. So can you do that? It's client's money. If you don't do that, he will move the money. He or she will move the money to another advisor, right? But in your IPS, you are saying that the client is only 30 years, should have 60 to 80% equity exposure. but the client is saying, I'm not feeling good about the market. I want to sell all of the equity and move to cash. What will you say? This will happen. This happens so many times. In real life, a lot of people call and they say, I want to sell my stocks. So advise the client, and the answer here is advise the client, but if the client insists, we have to sell it. Okay. But if you are going to sell it, you need to modify the IPS before you do it. If they are under an advisory relationship and you think in your due diligence, your fiduciary responsibility that it is better for the client to be staying invested in equity, then you need to modify it. Modify the risk tolerance of the client, and then say that the client might all say tactical allocation limits are you're going to increase it. Maybe instead of 60 and 40 being strategic asset allocation, your tactical asset allocation can be between 0 to 100 for equity. You can change that and then do that trade. Understand this? Change the IPS before you execute a trade that is in violation of your return IPS. So when handling unsolicited means you are not initiating the trade, the client is initiating the trade. Then ensure alignment with the client's portfolio's objective and risk profile. If it doesn't align, then change it in the statement. Jane Doe, head of the investment advisory firm, has recently observed an increasing interest among her clients in sustainable and green investments. To cater to this demand, Doe decides to look for a specialized sub-manager with expertise in sustainable investing. She prepares a detailed RFP based on template from the CFA Institute and receives multiple responses from both international and domestic firms. After reviewing the submission, she opts to partner with a firm that offers the most cost-effective fee structure, thinking this would be most beneficial for her firm's profitability. You understand this, what's happening? So she runs an investment advisory. Let's say you're running an investment advisory. A lot of them are interested in green investment, sustainable investment, ESG investment. She doesn't know how to do it. So she's looking for a sub-manager to manage the green investments, sustainable investments. So she does a RFP. She uses the template from CFA Institute, sends out a request for proposal. She picks the lowest cost one because thinking this will improve the profitability of the company. Okay. In choosing a sub-manager based solely on fee structure without considering their investment strategy, how it aligns with the client's interest, is Jane Doe potentially violating any standard of the CFA code of ethics and conduct? Because cost-effective sub-manager is in the interest of her clients? Yes. Because she should have considered alignment? No. If the sub-manager is reputable, it doesn't matter. Yes. But if our clients explicitly stated a preference for sub-manager with a higher fee structure, only if they have said that I want a manager who charges more, then it is a violation. Pretty straightforward. She should have considered the alignment between the sub-manager's expertise and 3D performance presentation. The standard, this is 3D performance presentation. When communicating investment performance information, members and candidates must make reasonable efforts to ensure that it is fair, accurate, and complete. So we have later on GIPS, right, about performance standards separately. But here we are talking about how to present fairly, accurately, and complete information to your clients about your fund performance. So the recommendation is that you should follow GIPS, Global Investment Performance Standards, and tailor performance presentation to the audience sophistication level. Okay, this is very important. See, if you are going to use some terminologies like trainer ratio, and you're talking to someone who is a homemaker with some money that she saved, and you're talking about some really complex ratios and returns, she might not understand that, right? You need to say it in a way in which they can understand, right? Usually visual ones, like you say, like, if you invested 10,000 with us in 2010, now this would be 50,000 by 2024, right? So they can easily visualize, okay, they are given 10,000, how it has changed over the last 14, 15 years. So these kind of easy layman, depending on the sophistication level, obviously, if you're talking to qualified institutional investors, then you can talk about a lot of the ratios because they can get that what you're trying to say. It's a relatively easier. For brief presentation, members should provide access to detailed information upon request and clarify that only limited information is being presented. So if it is a short talk, like, 5-10 minute presentation, you might not cover all the information, that's fine, but they should be able to access the detailed presentation. If you want more detailed information, you should be able to get it. Integrity in performance reporting, truthful, avoid misrepresentation, misleading statement about past or expected performance. They should not imply the ability to replicate past returns. Okay. So last year you got 80% return. You should not imply that next year also you will get 80%. Fairly obvious common sense, but that's what they are saying here. Use a composite similar portfolios for accuracy. Include terminated accounts. So these are all things that you might not do. So if I am showing the returns, I need to include a composite with all of the portfolios that should have been included, and include terminated accounts. If a client has left in the last couple of years, you still need to include them. Usually, so if I have some really good performing clients, their portfolio is like this 30, 70, 20, then I have minus 15, minus 30. So the people who are having negative returns, they would have been the one most likely to leave. Okay, so you should include the terminated accounts as well. Right, let's do this question. Global Growth Partners manages a multi-asset investment fund that allows clients transactions on a bi-weekly basis every other Thursday. For clarity and transparency, the fund calculates its NAV daily. In its quarterly reports, the fund presents quarter-to-date, year-to-date performance figures. However, Global Growth Partners has been reporting its performance based on either the NAV of the last transaction day of the quarter or the last calendar day of the quarter, whichever is higher. Do you understand that line, the last line? So whenever they are taking the NAV, ending NAV, they are taking, it's like a if statement. If the last transaction date NAV is higher, then take it, or else take the last calendar day's NAV, right? Whichever is higher, they are going with that. The choice is made at the discretion of the firm. The firm only randomly chooses this. And the reports merely states that the performance data is at the end of the quarter, without specifying the exact date used for calculation. John Lee, the fund performance analyst responsible for this calculation, is concerned about this practice and decides to consult with his manager regarding its appropriateness. So what is global growth? What are they doing? Is that fine? In questioning the method of performance reporting by Global Growth Partners, is John Lee acting in accordance with Code of Ethics and Standards? Yes, because he's ensuring compliance with Standard 3D. No, because the firm has the discretion to choose the most favorable NAV. Yes, but only if the clients have raised concern. No, because he's a performance analyst. His role does not include questioning the firm's reporting methods. Last standard in Standard 3, preservation of confidentiality. Members and candidates must keep information about current, former, prospective clients confidential. That is, you cannot share this information with anyone else unless there is some illegal activity on the part of the client. The only thing that supersedes client is the integrity of capital markets. If they are doing some illegal activity, then you can share that with the authorities. The disclosure is required by law, or if the client has permitted disclosure of the information. These are the three exceptions to confidentiality. So this part, primary duty, we just saw. Storage procedures, members should follow and recommend the implementation of firm procedures for secure electronic data storage. It has to be encrypted. Basically, all client data has to be encrypted. Members should restrict disclosure of client information to authorized co-workers also working with the client. So if one of your co-workers is asking for some client-related data, only if there is a need for she to know that data, you need to share. Only on a need-to-know basis. Just because she or he is a co-worker, you don't have to share it. They don't need to know about this client's information. It's confidential information. You shouldn't be sharing with your co-worker. Members may be required to report any illegal activities by clients to the appropriate authorities. Again, as I said, the only thing higher than the client is about integrity of capital markets. We saw in standard 2. Right? Always that comes higher than even the client. So if there's any illegal activity by the client, like you feel like they are doing some insider trading, etc., that you need to report to the authorities. Let's look at one question here. Alex, a portfolio manager at Henderson, is responsible for managing the portfolio of the Atlas Manufacturing's employee retirement fund. Recently, during a routine financial audit, Thomson discovers irregularities in the fund management expenses. These irregularities suggest that Atlas might be inappropriately charging the retirement fund for certain corporate expenses. Okay. Shortly after this discovery, government regulators contact Thomson to inform him that Atlas Manufacturing is under investigation for potential financial misconduct, which includes the management of its employee retirement fund. Thomson immediately consults with the legal team, who indicate that the charges to the retirement fund might constitute a breach of financial regulations. What's happening here? So first of all, is this a DB or a DC plan? Defined benefit or a defined contribution plan? What do you think? If it is a defined benefit plan, it is the company's money. If it is a defined contribution plan, it is the employee's money. Okay, the employees are giving money. You might be matching, the company might also be matching, but the money belongs to the employee. So if you are charging expenses to that, you are reducing whose money? It is not company's money, it is employees' money. So this is a DC plan that we are talking about. So corporate expenses, can you charge to the fund? You can't. But this company, Atlas, has been doing that for a while. So this is a financial irregularity, right? Now the question is this. In light of discovering potential financial irregularities and the ongoing investigation, what should Alex do? He should report his findings to a supervisor and advise Atlas to correct the irregularities, and if unsuccessful, seek legal advice for further action. B, keep the information confidential since the government is already investigating. There's no need to do anything else. Inform the government regulators about this discovery as it directly relates to the investigation. Wait for the results of the investigation before taking any action to avoid interference with an ongoing investigation. So I think we can skip this one, right? We have to do something, right? So that cannot be right. Wait for the results. This is also inaction. So that is also not right. The question is whether it is A or C. So C says inform the government regulators about his discovery as it directly relates to their investigation. So should he go directly to the government regulators, or should he first talk to his supervisor and advise Atlas Manufacturing, who is the client, to correct the irregularities, and if unsuccessful, then go for some legal advice? So this one is kind of a step-by-step approach, whereas here you're going directly to the government and talking to them. Which one is most of you, I think, are saying? Answer is A. I'll see why. He should first report his findings to the supervisor. So this is very standard approach. You will talk to your boss, and then you will talk to your client also and tell them what is the issue. Maybe sometimes they are not aware. Maybe sometimes it is wantedly they are doing, sometimes because they don't know that this is not permitted. So you should talk to them. And if they are able to change their course, that might be okay in many cases, like they're refunding the expenses, whatever they have incurred, they are refunding to the fund. And if they are not doing it, then seek legal advice. As a professional obligation to address the irregularities he discovered, he has to do something. So according to the standards of professional conduct, he should first report it to a supervisor, right? Obviously, that is always almost the first step. The next step involves advising Atlas Manufacturing to rectify it. Then he should consult legal if there are any other appropriate next steps. This approach ensures that Thomas is adhering to the professional and ethical standards while also taking proactive steps to resolve the issue. It aligns with the duty to act in the best interest of the clients. Who is the client, by the way? Oh, that's a good question. I forgot to ask. Who is the client actually? Is it Atlas Manufacturing? The people in the plan, in the pension plan, the employees of the Atlas. So what is the best interest? That they should get back the expenses, whatever they have been charged, they should get that money back, right? It aligns with the best interest of the clients, in this case, the beneficiaries of the retirement fund, and to uphold the integrity of the financial system. In such scenarios, the correct answer typically involves a portfolio manager acting ethically and in the best interest of clients. This includes addressing any discovered irregularities, etc. Options suggesting inaction, maintaining confidentiality without further steps, passively waiting, those are all wrong, right? So that government one, yeah, I understand why some of you chose that, but that is you are not giving any opportunity to correct that issue. You're going directly to the government. That is not usually a recommended step. If there is, the legal advice is that you have to report to the authorities, then you should do it. But not all regulatory issues, you go to the government directly. So let's look at some more questions. Question 33, can you read this one and tell me the answer? Samantha is CIO at XYZ. She is to allocate new investment opportunities among the firm's various clients. New tech startup has just opened up for investment, and Lee believes the startup is a high growth potential. She decides to allocate the majority of available share to her own family accounts, which she manages. So she's also managing her family's accounts, so she allocates to them. And the remaining shares are allocated to other clients based on their account size. Okay. Did Lee act in accordance with standard 3A loyalty, prudence, and care? Yes, because she has the right to allocate shares to her family accounts as she manages for them as well. No, because Lee did not act in fairness in allocating. Yes, because the allocation was based on account size, which is a standard industry practice. It is fine because she's allocating based on account size. That is what you're saying. C, what about you? We don't know. They didn't say that. She first allocates to the family accounts and then she's allocating to other clients based on account size. It is B, right? I think so. It seems like B. Because see, allocating on account size is an industry standard. That is fine. If someone has $10 million, another person has 1 million, the person with 10 million will get 10 times more shares. That is fair. Okay. But to allocate first to the family accounts is not fair, correct? They should allocate to all accounts based on account size. So that's what we talked about. No, because Lee did not act in allocating the new investment opportunity. Question 34, Michael Johnson, a CFA charter holder at Greenfield, he receives information about a significant dividend cut by Blue Chip. Then he decides to first inform and sell the stock for his high net worth clients and institutional investors before notifying his smaller retail clients. By the time he contacts his retail clients, the stock price has already fallen significantly. Did Johnson act in accordance with standard 3B fair dealing? Yes, because institutional clients have higher priority. No. Yes, because Johnson eventually informed all his clients about the dividend cut. So this is a very, very easy one. You will not get so easy questions in exam. This is more of a conceptual check. Yeah, B, okay. This is B. Alice Brown, a CFA charter holder and financial advisor at Sterling, manages the portfolio of the Robinsons, a retired couple with a moderate risk tolerance, whose primary investment goal is to generate stable income. Brown identifies a new high-yield bond fund which has performed well over the past year. Recognizing the potential risk associated with this fund, she carefully considers the risk tolerance and income needs. After a thorough analysis, she concludes that a small allocation to this fund could enhance the portfolio's income potential. She discusses the opportunity with the Robinson, explaining the potential risk and rewards. After obtaining their consent, she reallocates a modest portion of the portfolio to the high-yield bond fund. So this is a retired couple. So high yield obviously is riskier. So, but she does some analysis and she thinks a little bit of allocation is okay and she allocates it. Did she act in accordance? Yes, because she assessed the suitability and got consent. No, because investing in a high yield bond fund is inherently risky and not suitable for retained clients. C, yes, because the fund's strong past performance justifies its inclusion in the portfolio. Because the high yield fund has been doing well, you can include in the portfolio. So which is the right answer, A, B, or C? Everyone saying A? Very good. So I think so these are all I would categorize as easy questions. But A is correct. Very good. Henry, a CFA charter holder and manager of small cap fund at a company. is doing a presentation for clients, using marketing presentation. In this presentation, Adam includes a graph showing the fund's performance for the last 5 years, which is industry standard, right? Here, the fund is significantly outperforming the small cap market index. However, the fund strategy was changed 18 months back. Since then, its performance has been more aligned with the index. Adam doesn't include this information about the strategy change or its impact on recent performance. Is Adam's action in alignment with standard 3D performance presentation? Yes, because Adam accurately presented the fund's 5-year performance, which is a standard performance measurement period. No, because Adams failed to disclose the change. Yes, because primary objective is to show the long-term performance, not short-term strategy changes. You need to disclose the strategy change, right? Because that is a major, that is going to affect the future performance, right? So you need to disclose, yeah, 5-year, you should talk about the long-term returns, but you should also disclose that the fund strategy has changed now, so that 5-year performance might not be as relevant. So we need to talk about it.